The silver price plunge. Nobody is talking about what's really next. Silver just lost nearly half its value. In months, not years. Months. And the strange part, it happened after a peace deal was signed, when everything was supposed to calm down. So why didn't it? Why did one announcement erase what took silver years to build? Somewhere between Washington and a war zone half a world away, a decision was made. A decision most investors never even saw coming. And it's still happening right now, quietly, while almost no one is watching. By the end of this video, you will understand exactly what triggered this collapse. And more importantly, what is coming next, because what happens in the next few months could decide who builds real wealth and who simply watched it happen. Stay with me. Now, before we go any further, I need to ask you for something. And I'm going to ask you the way you'd ask a wise old friend for a favor. Not a big one, just an honest one. If you're someone who values your hard-earned money, if you believe in understanding the truth before the headlines catch up, then do an old soul like me a simple favor. Hit that subscribe button. It costs you nothing, but it means everything to this channel. And tell me, where in the world are you watching from today? Drop your city, your country, down in the comments. I read every single one. Now, let's get into it. The silver price plunge. Nobody is talking about what's really next. In late January 2026, silver touched a price that had never been seen before. It reached $121.78 per ounce. People who held silver felt rich. People who did not hold silver felt they had missed their chance. Across social media, stacking channels celebrated. It looked like the beginning of something historic. Then, within months, that story changed completely. By early June, silver had fallen to around $63. That is a drop of nearly half its value in a matter of months. The metal had lost more than 40% of its value since the war between the US and Iran began in late February. For an asset that millions of ordinary investors had been told was a safe haven, this was not supposed to happen. The street. So what actually happened? Most people assume the answer is simple. War broke out. War is scary. Scared investors usually buy gold and silver because these metals are seen as protection against chaos. But silver did not behave the way people expected. Silver fell not because geopolitical risk disappeared, but because of what the conflict was doing to inflation expectations, and through them to interest rate expectations. The street. This is the part almost no one explains clearly. War in the Middle East pushed oil prices higher. Higher oil prices mean higher transportation costs, higher energy bills, and higher prices on almost everything else. That is inflation. And when inflation rises, central banks usually respond by raising interest rates to slow it down. Here is where it gets important for anyone holding precious metals. Gold and silver do not pay interest. They sit quietly in a vault or a drawer. When interest rates rise, bonds and savings accounts suddenly offer a better return for doing nothing. Investors begin to ask a simple question: why hold a metal that earns nothing when a bond can pay me 5% a year? That question, multiplied across millions of investors and trillions of dollars, is enough to crush a market. This is exactly what began happening in 2026. As the war dragged on, markets stopped pricing in rate cuts. They started pricing in the opposite, a Federal Reserve that might actually raise rates to fight war-driven inflation. That single shift in expectation did more damage to silver than the war itself. By mid-June, even after a peace agreement was signed between the US and Iran, silver did not bounce back the way many expected. Silver and gold prices did not react as positively to the signed peace agreement as stock markets did. Investors were more focused on inflation levels pushed higher by the war and on the Federal Reserve seriously considering raising rates later in the year. Yahoo Finance. This detail matters more than almost anything else in this story. A peace deal is supposed to calm markets. It calmed stocks. It did not calm silver. That tells a careful observer something important. Silver was never just reacting to the war. It was reacting to what central banks might do next. And that is a very different kind of problem. One that does not disappear just because a ceasefire is signed. There's one more number worth sitting with. The gold to silver ratio, a simple measure of how many ounces of silver it takes to buy 1 ounce of gold, moved sharply during this period. At the correction's peak, the ratio reached between 85 and 89. Historically, a ratio that high has only appeared during moments of extreme dislocation in the market. It happened briefly in 2020, during the worst of the pandemic panic. Now it was happening again. Gold-silver. For business-minded observers, this is the real story. Not panic, not hype. A cold, mechanical relationship between interest rates, inflation expectations, and the price of a metal that earns no yield. Silver did not fall because people lost faith in it. It fell because the cost of holding it, measured against what bonds and cash were suddenly offering, became harder to justify. The question now is, what happens next, once that interest rate picture starts to shift again? That is where the real opportunity and the real risk begins to take shape. The silver price plunge nobody is talking about. What's really next? To understand what comes next, a different question must be asked. Why does silver behave so differently from gold? Most people, even experienced investors, treat the two metals as the same trade. They are not. Gold has one job. It stores wealth. Central banks hold it. Investors hold it during fear. It does not get used up in a factory. Silver carries two jobs at once, and that double role is exactly what made 2026 so confusing for ordinary investors trying to make sense of the crash. The first job is the one everyone already knows. Silver acts as a monetary metal, much like gold, moving with inflation fears, interest rate expectations, and confidence in currencies. That explains the surge to $121 in January. That explains the painful fall that followed once rate hike fears returned. But that is only part of the picture. Roughly 60% of silver's price behavior comes from somewhere else entirely. Industrial demand from factories, solar farms, and electric vehicles. Gold silver. This is the detail almost no headline explains properly. Silver is not just something people buy when they are scared. It is something the modern economy physically consumes. Silver industrial demand reached a new record high in 2024, hitting 680.5 million ounces with three structural forces: solar panels, electric vehicles, and data center infrastructure, all pulling in the same direction at once. Unlike fear-driven buying, this kind of demand does not disappear when a peace deal is signed or a Fed chair gives a speech. Factories still need the metal whether headlines are calm or chaotic. Gold, silver. And here is where the supply side becomes critical. Silver cannot simply be mined faster when prices rise, the way some commodities can. Roughly 70 to 80% of all silver comes out of the ground as a byproduct of mining for copper, lead, and zinc. When those mining operations slow down for their own reasons, silver production falls with them, regardless of what silver itself is trading at. This is a strange and underappreciated fact. The price of silver, in large part, is not really controlled by silver at all. It depends on decisions made in copper and zinc mines around the world. Gold, silver. The result of this mismatch, rising industrial demand against supply that cannot simply expand, has produced something rare in commodity markets. 2026 marks the sixth consecutive year of a global supply deficit in silver. 6 years. Not one bad year. Not a temporary shock. A sustained, structural gap between how much silver the world uses and how much new silver actually reaches the market each year. Gold, silver. Solar power explains much of this pressure. Solar photovoltaics alone consumed 29% of all silver industrial demand in 2024, a dramatic rise from just 11% a decade earlier in 2014. Every solar panel manufactured anywhere in the world uses a measurable amount of silver for its electrical conductivity. And the global push towards solar energy has only accelerated, not slowed, even as silver prices climb to record highs. Gold, silver. It would be reasonable to assume that manufacturers, faced with expensive silver, simply found ways to use less of it. To some degree, they did. Solar manufacturers cut the amount of silver used per panel by roughly 19% in response to high prices. But this efficiency gain was not enough to offset the sheer scale of new solar installations being built worldwide. The retreat in silver per panel was outpaced by the sheer number of panels being produced. Gold, silver. At the same time, something else was happening that gets far less attention than it deserves. Even while the price crashed by nearly half, physical buyers did not walk away. Global silver coin and bar demand rose 14% in 2025, and physical investment in India alone surged 33%. This is not the behavior of a market in genuine decline. It is the behavior of patient buyers treating a falling price as an opportunity rather than a warning. Gold, silver. So the picture that emerges is layered. On the surface, silver looks like it collapsed because of fear around interest rates. Underneath that surface, a structural shortage has continued building for 6 straight years, driven by forces that have nothing to do with central bank meetings, solar installations, electric vehicle production, and data center expansion tied to the global race in artificial intelligence. These two forces, one short-term and emotional, one long-term and physical, do not always move together. For a period, the short-term force wins, and the price falls hard. But the structural deficit does not vanish just because sentiment turns negative. It simply waits. And when the monetary fear that has been suppressing silver eventually fades, the underlying shortage that never went away is still sitting there, unresolved. That tension, between what panic is doing to the price today and what physical scarcity is building underneath it, is the real story most coverage of silver's crash has missed entirely. The silver price plunge nobody is talking about. What's really next? To understand where silver goes next, attention has to move away from the metal itself and toward a single person sitting inside a marble building in Washington. His name is Kevin Warsh. Most retail investors barely registered his name. Institutional desks did not look away from it for a second. The reaction tells the whole story before the man had even taken office. On January 30th, 2026, the moment Trump announced Warsh as his nominee to replace Jerome Powell, silver futures fell 30% in a single day, their worst single-day collapse since 1980. Gold dropped 11% in the same session. A market does not move like that on rumor. It moves like that when professional capital concludes, instantly and collectively, that the entire script for the year has just been rewritten. Financial content. Why did one name cause this much damage? Warsh is a former Fed governor known for hawkish leanings and a preference for a smaller central bank balance sheet. For months before his nomination, markets had been pricing in a different future. A Fed willing to cut rates aggressively, let inflation run a little hot, and keep the dollar weak. That expectation was exactly what had pushed silver to its January peak above $120. Warsh's arrival did not just disappoint that expectation. It reversed it entirely, overnight. Financial content. Then came his first real test as chair. On June 17th, the Federal Reserve held interest rates steady at 3.5% to 3.75%, with all 12 voting members in agreement. On the surface, a hold sounds neutral. Underneath it was something far more telling. The Fed's own projections showed that 9 of the 18 voting members expected an interest rate hike before the end of 2026, with 6 of those 9 expecting 2 separate quarter-point hikes. Fox business, Fox business. This is the detail that should concern anyone holding silver purely on the assumption that rate cuts are coming. Half the room is no longer talking about cutting. Half the room is talking about raising. There was a second, quieter signal from that same meeting that deserves just as much attention. Warsh chose to withhold his own personal rate projection from the Fed's quarterly forecasting tool known as the dot plot. In doing so, he became the first Fed chair in 14 years to sit out a tool that has guided market expectations since 2012. Gold, silver. Why does this matter to someone holding physical metal rather than a trading terminal? Because markets depend on predictability. Investors price assets based on what they expect a central bank to do. When the person running that central bank deliberately removes a piece of guidance markets have relied on for over a decade, he is not being careless. He is sending a message about how this Fed intends to operate going forward. Less guidance, less certainty. More room for the Fed to surprise markets in either direction without warning. Gold, silver. The justification behind the Fed's caution is not invented. Since the Iran war began in late February, inflation has climbed, with the Consumer Price Index reaching an annual rate of 4.2% in May, the highest level recorded since April 2023. A Fed chair, confirmed by the slimmest, most partisan Senate vote in the institution's history, does not have the political room to look soft on inflation in his first meeting. The jump in both consumer and producer prices makes it far more difficult for Warsh and other policymakers to even discuss a rate cut in 2026. CBS News, CBS News. This is the structural tension sitting underneath everything happening to silver right now. President Trump has openly pushed for lower rates to support growth. The data Warsh is staring at says the opposite is needed. Somewhere between those two pressures, the next move on interest rates will be decided. And whichever way that decision breaks, silver will be one of the first assets to feel it, because, unlike gold, silver's price carries no cushion of pure, safe haven demand to absorb the shock. For now, the market has settled on an uneasy truce. Rates are frozen, inflation is elevated. The Fed chair has deliberately made himself harder to predict. That is not a stable equilibrium. It is a pause before a decision that has not yet been made. And the direction of that decision is the single largest variable standing between silver's current price and whatever comes next. The silver price plunge. Nobody is talking about what's really next. So where does this leave silver and the people deciding what to do with it right now? Strip away the noise and two forces are pulling against each other. One is short-term and emotional, a hawkish Fed chair, a war-driven inflation spike, and a market still recalculating how aggressive central bank policy will be for the rest of the year. The other is long-term and physical, a 6th consecutive year of supply deficit, an industrial base that keeps consuming silver regardless of headlines, and patient buyers who kept stacking even as the price fell. What does the institutional world think happens when these two forces finally resolve? The honest answer is that there is no consensus. The spread between the lowest and highest forecasts for silver this year is among the widest seen for any major commodity in recent memory. That spread is not noise to ignore. It is information in itself. It tells a careful observer that the market genuinely does not know what happens next. Gold, silver, gold, silver. Still, the range of opinion is worth laying out plainly. JP Morgan forecasts a 2026 average near $81 an ounce. ING targets $83. UBS projects $85. Bank of America has gone further. raising its full-year average forecast to roughly $86, citing supply shortages and long-term industrial demand tied to the current energy crisis. On the far end of the spectrum, Citigroup's second-half target sits at $108, built on the view that the physical shortage is more acute than markets currently appreciate. Just 2-trade plus 2. None of these institutions are predicting a return to the kind of weakness that defined the worst weeks of the correction. The disagreement is not about whether silver recovers, it is about how far and how fast. What ties almost every forecast together is the same underlying logic explored throughout this analysis. Institutional targets cluster around $80 to over $100 by year-end, with a recovery expected in the second half, supported by Fed policy, ongoing industrial demand, and the sixth consecutive year of global supply deficit. The structural shortage has not gone anywhere. It has simply been overshadowed, for a few months, by fear around interest rates. Just 2-trade. This is the lesson sitting underneath the entire story of silver in 2026. A single political appointment was enough to erase months of gains in a single trading session. A single press conference was enough to keep that pressure in place for weeks. Sentiment moves fast, and it moves first. But sentiment is not the same as supply. 6 years of deficits do not get resolved by a Fed decision. Solar panels, electric vehicles, and data centers do not stop consuming silver because a chairman declined to publish a forecast. For the business-minded observer, the takeaway is not a prediction of where the price lands by December. It is a recognition of which forces are temporary and which are structural. Interest rate fear is temporary. It rises. It fades. It gets repriced the moment new data arrives. A physical deficit that has persisted for 6 straight years against a backdrop of accelerating industrial demand is not temporary in the same way. It does not resolve itself quietly. At some point, the gap between what the world consumes and what the world produces has to be closed by price. That is the real story behind the plunge nobody was talking about. Not a crash, a pause, forced by policy, not by physics. And physics, in the form of supply and demand, has a long history of eventually winning that argument.